is your view still one that the Fed is confusing things a little?
Oh, absolutely. The Fed, in fact, in December said the risks were balanced around the economic outlook. That had been a change from nearly balanced in the meetings before. So they were nearly balanced, then they became balanced in December. And then yesterday, now, of course, this wordsmithing may not seem like a lot to people, but it really is. Yesterday, they said that they couldn't tell you what the balance of risks to the outlook was or is because we're not sure where markets are going. The last time the Fed did something like this was March 2003, as we were on the cusp of re-entering Iraq from a military perspective. So here we are, roughly 13 years later, and yet the Fed doesn't know exactly where the risks are. And unfortunately, that provides or causes a lot of uncertainty in financial markets and causes extra risk aversion, which causes more volatility. And it's really gotten messy in my mind.
But don't you think they should just wait to see what the data shows in terms of the impact of financial markets and international weakness, Joe?
Sure, Sarah, absolutely. But the problem is that the Fed needs to treat the financial markets as if it's an intelligent 13-year-old, one that doesn't have a lot of patience and can only grasp little certain specific things at one point in time. And unfortunately, this data dependency itself is not very clear. And the Fed itself isn't programmed to set itself up to be clear with things. In other words, the Yellen-led Fed, and this is true of the Bernanke-led Fed, has really focused on labor markets and output gaps and things that are somewhat esoteric but really drive their thought process. And therefore, they can't pivot when market conditions change. And I'm worried because markets tend to be very good forward-looking indicators of growth. So if the Fed actually waits for the data to become clear, the economy at that point may have actually tipped into recession.
But, Joe, of course, central banks around the world need the ability to be able to make a change in their policy. Now, whether that's an outright cut or hike is one thing, but rhetoric is part of their policy. So surely there is some sense in what Janet Yellen's doing. She's giving herself space to become more dovish in a few months' time, if necessary. I mean, if you look at the Bank of Japan, for example, which, of course, has its meeting this Friday, they have such little flexibility, both in policy and rhetoric, to change things. And maybe Janet Yellen's just giving herself room to be more dovish at a later date if necessary.
I mean, that sounds very logical, but the problem is that central banks are where they are in part because of policies that had preceded what they're currently doing. In other words, the Fed left rates, in my opinion, way too low, too long back in the 2000s. And they should have been raising rates much earlier than what they did. I don't believe you should raise rates, or at least as much as they say they're going to raise rates so late in the business cycle. So that's something to consider. But also keep this in mind. Central banks, specifically the Fed anyway, when they reverse course very quickly. So you say, yes, we want to see more data. We need to see what's going to happen with the economy. The thing is, you look back before the 2000 recession, they went from a tightening bias to outright easing within about 8 weeks. If you look back at the last financial crisis, the Fed went even faster in terms of its switch from everything is okay to we need to reverse course. So I would argue, yes, what you say makes sense, but history shows that markets tend to lead the Fed, not the other way around.
So, Joe, is the upshot here, March seems to be the decision in question. Is it as simple as if the market calms down, then they'll raise interest rates in March, and if it doesn't, then they won't? Pretty much.
Sad but true, yes. Tell me where the S&P 500 level is, and that'll dictate what the Fed does. Assuming, of course, the fixed income market is not pricing or is pricing a hike. So the Fed is going to look at two things. I know this sounds crazy, but this is how they behave. Where's the market and where's the stock market? And, of course, what are the fixed income markets discounting? The problem, though, Sarah, is that with the Fed reintroducing the language they had in September, which highlighted their concerns about global markets, we know that it took them a meeting in October to take it out before they could hike in December. So it seems what the Fed has done, they've made it very hard for them to go in March, even if markets improve, because people are going to be looking for them to take the language out before they can hike again. The situation's become very messy, and this is the dark side of transparency and trying to communicate to markets when in reality you're not really sure what you want to do.